Well, a little earlier, I spoke to Davies, who's the CEO of Javelin Wealth Management, and I asked him whether it might be time to panic.
There's no reason for panic. I mean, there is some reason for caution, but again, it's a little bit more market specific than we have seen in previous sell-offs. So if we cast our minds back to the ancient history of 1998, when we had a problem in Thailand which very quickly snowballed around the rest of the region, we're not seeing the same sort of systemic risks now that we did then. There are issues in individual countries and in individual markets, but it's not the same broad brush development that we saw then and were very wary of at the time. So looking forward, I think there's still quite good value to be had, both in Asia and around the world, in the sense that on the assumption that earnings growth begins to accelerate, as I think we will see during the course of 2014, it becomes less of an issue about what central banks do and much more about what companies are doing in terms of margin enhancement, capital expenditure and consumption spending, all of which at the moment are still looking pretty solid.
But let's talk about sentiment again for just a moment, because much of what's been happening globally recently has been underpinned by a sense from the major investors that, okay, we are beginning to see traction in the US recovery, we're beginning to see the emergence of a European recovery, and this was where the hope was lying. The numbers we saw out of the US last night, once again raising that niggling doubt in the back of people's minds that perhaps it's not going to happen as they were hoping.
Yeah, but the interesting thing about what's happened over the last 4 or 5 weeks has been that if we had the same data in the second half of last year, markets actually would have and did go up. Why? Because the assumption was that the Federal Reserve would back off on its tapering program for quantitative easing, and therefore easy money would remain in place for longer than anticipated. It would remain in place and be very accommodative for as long as it needs to, and that's what the Federal Reserve has been consistently saying. Fast forward to January, it now seems as though that what was bad economic news is now being treated as bad news and therefore is bad for markets, whereas last year it was all meant to boost liquidity flows, which is generally market positive. So
right, but
there's a change of interpretation, but I don't necessarily think there's any reason to panic or to feel that necessarily anything has materially changed in the way that we should view that information.
Well, one thing has materially changed, surely, and that is back then tapering was a threat. Now, tapering is a reality, and that giant sucking sound, if you like, of money heading back to where they think there's going to be better interest rate returns is being felt all over the world.
That's true, but there is a big gap between tapering, and we're not talking about a complete removal at the moment of that bond buying program, but there is a big difference between tapering and the point at which interest rates actually start rising, and that really remains the number one issue, which I think is still quite supportive for equity markets on a global basis, which is interest rates are going to remain low. Where else are you going to put your money? Because you don't want to put it into fixed income.
So very quickly, no reason for too much concern here, an investment strategy as before, is it?
Yes, pretty much so. Looking for selective buying opportunities and looking for areas where market conditions look to have been oversold.